Someone with a credit score of 780 and $150,000 in investable assets just got approved for a $50,000 loan at 5.2%. Someone with a score of 610 and $1,200 in savings just got approved for the exact same $50,000 at 18.9%. Same loan amount, same bank, same month. The second person will pay $47,000 more in interest over the life of that loan. That's not market fluctuation. That's tier assignment. And most people don't even know the tiers exist. Today, I'm walking you through the 3 borrowing categories that every lender uses, the rate ranges that define each one, and the specific variables that determine which tier you're locked into. Let's get into it. Here's something no credit card issuer puts in their marketing materials. 68% of Americans with credit scores below 640 are still in that range 5 years later. 5 full years of making payments, managing budgets, trying to improve their situation, and they're statistically likely to stay exactly where they started. That's not because they're bad with money. It's because the tier they're assigned creates conditions that make escaping it extremely difficult. The difference between Tier 1 and Tier 3 borrowing isn't small. It's structural. Someone in Tier 1 pays an average APR of 22% on credit cards. Someone in Tier 3 pays 14% on a $15,000 balance. That's $3,300 per year versus $2,100. Over a decade, we're looking at a $12,000 penalty for being in the wrong tier, and that's just credit cards. Scale that across auto loans, personal loans, mortgages, and any other form of debt, and the lifetime wealth differential reaches 6 figures. There are 3 borrowing tiers built into every major lending institution's underwriting system. Tier 1 is survival borrowing. These are people paying emergency rates on urgent needs. Tier 2 is transition borrowing. These are people paying moderate rates to build capacity. Tier 3 is leverage borrowing. These are people paying minimal rates to acquire assets that appreciate faster than the interest accrues. Same financial system, 3 completely different experiences depending on where your credit profile lands you. Let me break down each tier, starting with the one where most Americans are currently stuck. Tier 1, credit score below 640, limited or no collateral income that's inconsistent or hard to document. This is the high cost zone. If your credit profile puts you here, you're paying between 18% and 29% on unsecured borrowing, and the math compounds fast. Let's say you need $4,500 for an emergency. Transmission fails, medical bill hits, whatever. You don't have it in savings, so you finance it on a credit card at 23%. If you're making minimum payments, you'll spend 3.5 years paying it off, and you'll pay $2,900 in interest. That $4,500 expense actually cost you $7,400. You paid 64% more than you borrowed just to access the money when you needed it, and here's what makes this brutal. If you're earning $42,000 a year, that $2,900 in interest represents nearly 7% of your annual gross income. You just spent almost a month of work servicing one emergency debt. This isn't a rare occurrence either. The average Tier 1 borrower faces emergency debt situations 3 to 5 times per decade. That's $8,700 to $14,500 in interest paid over 10 years on debt that someone in Tier 3 would have paid less than $2,500 to service. But that's just unsecured credit. Personal loans in Tier 1 run 15% to 21%. Auto loans sit at 13% to 18%, even when the vehicle itself is collateral. Every single financial product available at this tier is priced above the average return you'd get from investing that same money, which means borrowing doesn't build wealth for Tier 1, it extracts it. And there's a feedback loop that keeps people stuck here. 61% of Tier 1 borrowers report being unable to save $400 in a given month. That's not random. When your debt service is consuming 18% to 28% of your monthly income, there's literally nothing left to build the credit history or asset base you need to move up. If this breakdown is giving you clarity on how credit pricing actually works, go ahead and subscribe. I break down financial mechanics that most people interact with daily but rarely see explained in structural terms. How credit scoring determines tier placement, why rate differentials compound into wealth gaps, the mathematical relationships between borrowing costs and net worth outcomes. No motivation speeches, no hype. Just the underlying system explained clearly. Drop a comment with which tier you think you're in if you want. I'll see you in the next one. Now let's zoom out and look at the full structure. 73% of people borrowing at high rates are still doing it 5 years later. That's not bad luck. That's the tier keeping them there. Take a $10,000 loan. Someone in the leverage tier pays about $450 in annual interest. Someone in the survival tier pays $2,400 for the exact same amount borrowed. That's not a product difference. That's tier assignment determining your cost before you even walk in the door. The 3 tiers sort by outcome. One destroys wealth through rates that exceed any reasonable return. One stays roughly neutral. One builds wealth because borrowing costs less than the assets appreciate. Your tier dictates which products you can access, which means the system decides what's available to you based on what you already have. Tier 1 sits below a 640 credit score with little to no assets and income that fluctuates. The products available here are payday loans, high APR credit cards, subprime auto financing, rent-to-own agreements. Rates run 18% to 29% on unsecured debt, 12% to 18% even when there's collateral involved. A $5,000 emergency financed at 24% costs $2,346 in interest over 3 years. You're borrowing for survival situations, medical expenses, broken transmissions, rent shortfalls, utility shutoffs. Each time you borrow, you're paying 20% to 40% of the borrowed amount just in interest. And here's the trap. Those monthly payments eat the exact income you'd need to save up an emergency fund or build credit history. The tier keeps you in the tier. Tier 2 runs from 640 to 750 on credit score with moderate income and some assets in place. You get access to standard credit cards, personal loans, conventional mortgages, auto financing. Rates sit between 8% and 15%, depending on your exact score and what you're putting up as collateral. A $30,000 car loan at 11% means you're paying $16,274 in interest over 5 years. You're borrowing for capacity building now. Education, reliable transportation, home ownership. The wealth impact here is almost neutral. Interest costs eat up most of the asset gains you're trying to create. And there's a hidden drain. Money going to service 11% debt could be earning 9% if invested instead. You can see Tier 3 from here, but actually reaching it takes years. Tier 3 starts above 750 with substantial assets, verified income, and collateral you can actually use. The products here are securities-backed loans, business credit lines, portfolio lending, jumbo mortgages. Rates run 3% to 6% depending on what you're backing the loan with. Borrow $200,000 at 4.5% to buy property that's appreciating at 6% annually. You're paying less to borrow than the asset is gaining in value. This is asset acquisition funded by borrowed capital. The wealth impact flips positive. The money you borrowed is producing more than it costs you. You're using the bank's capital to buy appreciating assets, keeping all the upside, and paying a minimal fee for access. That's the mechanic that separates this tier from the other two. Credit score is the gatekeeper between these tiers. The thresholds that trigger changes are 640, 700, 750, and 800. Every 50-point move up drops your rate by about 3% to 5%. Your score breaks down as payment history at 35%, utilization at 30%, credit history length at 15%, credit mix at 10%, and new credit at 10%. Here's the poverty penalty baked in. Low credit limits create high utilization percentages even when you're using credit responsibly. Moving from 580 to 720 takes 18 to 36 months of perfect payment behavior, plus getting utilization down. You control on-time payments, keeping utilization under 30% and avoiding new inquiries. You don't control history, length, existing limits, or past crises that already happened. But credit score is only half the equation. Assets change everything. Secured versus unsecured borrowing creates an 8% to 12% rate gap on the same person. Have $15,000 in savings. You can get a secured loan at 9% instead of unsecured at 19%. Own a home. You can tap equity and convert high-cost debt into low-cost debt. Have a $100,000 investment portfolio. Borrow against it at 5% instead of putting expenses on a credit card at 21%. The catch is you need assets to access cheap borrowing, but you need cheap borrowing to build assets. The breakthrough threshold sits around $25,000 in liquid assets. That's typically what it takes to move from bridge tier into leverage tier. Let's look at what this means over a lifetime. Take two people earning $45,000 annually. Both borrow $80,000 total over 20 years. Person A is in survival tier, makes 8 borrowing events at an average 21% rate, pays $47,300 in interest. Person B is in leverage tier, makes 3 borrowing events at 5%, pays $9,100 in interest. That's a $38,200 difference for accessing the exact same amount of capital. Pure tier tax. If person A's extra interest had been invested at 7% instead, that's another $98,000 in opportunity cost. Total lifetime disadvantage from tier placement alone is $136,200, and it passes down. Children inherit their parents' tier position through lack of credit access and no asset base to start from. So what actually moves you between tiers? Not cutting up credit cards, you need utilization history to build score, not debt consolidation at the same tier. That just reshuffles the same problem, not waiting for perfect conditions. Tier climbing happens during messy situations. What works is getting added as an authorized user on someone's established account. That can jump your score 30 to 60 points in 6 months. Secured cards with a $500 deposit build credit foundation and graduate to unsecured after a year. Dropping utilization below 30% across all cards adds 40 to 80 points. Automated savings of $100 to $200. Monthly hits $5,000 in 3 years and unlocks secured loan access. Survival to bridge takes 24 to 36 months. Bridge to leverage takes 3 to 5 years. No shortcuts exist, but knowing the mechanics stops you from wasting effort on things that don't change your tier. The 3-tier structure exists because it maximizes bank profit. High rates from survival tier, volume from bridge tier, asset relationships from leverage tier. Your current tier isn't a moral judgment. It's classification based on wealth markers you mostly inherited or encountered circumstantially. Once you see the tier mechanics, your borrowing decisions shift. You stop doing things that reinforce your tier and focus on variables that actually move you. Here's the critical part. Identical borrowing behavior produces opposite wealth outcomes depending on which tier you're in. Same debt, completely different destination. Most people optimize the wrong variables. They focus on monthly payment size instead of rate structure, on approval instead of terms. The tier you occupy determines whether borrowed money builds your wealth or drains it.